Hi everybody, my name is Griffin Bridgers. Welcome back to the basics of generation skipping transfer tax. For this part 11, we're going to dive into Crummey withdrawal rights and look at a brief overview of why we have them and look at how they interact with both the gift and the GST taxes and some of the nuances and differences you're going to see when it comes to Crummey rights for GST tax purposes as opposed to gift tax purposes. Before we get started, I want to remind you again, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, to recap, last time we discussed the estate tax inclusion period and how its existence essentially defers any automatic or manual allocation of GST exclusion till the earlier of the transferor shifting or the close of that ETIP period. We also briefly discussed that there's this direct payment exception, not in part 10, but in an earlier part, that covers the gift tax exemption for direct payments of tuition and medical expenses, and how that also applies in the GST tax world for both direct skips and taxable distributions. And I bring that up to show this common theme that a lot of the exemptions and exclusions that exist under the gift tax carry over and do indeed also apply for purposes of the GST tax, including the gift tax annual exclusion, because what we're going to talk about today is the fact that there is a GST tax annual exclusion that applies perfectly the same as the gift tax annual exclusion, except in one small area, and that's Crummey rights. So, why do we have this annual exclusion to begin with? Well, it's to keep you from having to pay gift or GST tax or report it on just small incidental gifts that you make during the year. It's really designed to create a threshold over which the IRS considers transfers of wealth to be intentional transfers of significant chunks of wealth, which are designed to be replacements for the estate tax. So that's really why we have this threshold here of $16,000 per donee. So that $16,000 per donee applies for the gift tax, but it also applies for the GST tax if the donee is a skip person. But there's one catch. To get this annual exclusion, the transfer has to be a present interest. What does that mean? It means that whoever is receiving it, the donee, has to have the immediate and present right to enjoy the property. As we're going to see, typically that doesn't exist in a trust. And we get around that, as I'm going to explain more, using what's called a Crummey right. So what is a Crummey right? Well, it's a transfer where you manufacture a present interest for a transfer in trust, because typically a transfer to a trust defers the enjoyment of property until some future point, maybe in the discretion of a trustee or when some other beneficiary's interest terminates. So you're creating a future interest which doesn't qualify for the gift tax annual exclusion. But a Crummey right was a way to get around this, and this isn't a creature of tax code or regulation. This is really a case which has been developed and refined over the years involving the Crummey family. And usually these are better known as withdrawal rights. What you do is you give a beneficiary a limited window of time to withdraw their proportionate share of a trust contribution, but only up to the gift tax annual exclusion that's available to the donor. So when you give this right, it creates a completed gift to the trust, and the donor gets to wipe their hands clean and all is well. But Crummey rights are not treated consistently when you compare them under the gift tax versus under the GST tax. And we're about to see why, because as we're going to see, even though Crummey rights aren't included in the tax code for gift tax purposes, they are addressed in the tax code for GST tax purposes. So the big difference is that for gift tax, you focus more on the procedure, not necessarily the structure. You simply need to notify a beneficiary of the existence of the Crummey right, the amount and when it lapses, and give them a reasonable amount of time between notice and lapse to exercise that Crummey power. So that procedure focus is really what came out of that Crummey case that we talked about in the last slide. But in the tax code 2642C2, there are specific requirements set forth to get the annual exclusion for GST tax purposes. And while this code provision doesn't define a Crummey power, it does in operation add on some technical and structural elements to a Crummey power which must be satisfied in addition to the gift tax requirements in order to get the GST tax annual exclusion. And this would be for a Crummey right held by a skip person, just to clarify. So the first requirement is that before and after the lapse, no other person other than the skip person holding that Crummey power can benefit from the trust property to which the power applied. And the second requirement is that at the skip person's death, the unlapsed portion of the Crummey power must be included in their gross estate. So to add some color to that, what that usually means is if you have a Crummey power, you hold it for a certain window of time, maybe 30 days, 60 days, the end of the year, whatever the case might be, and then it usually lapses, or at least lapses to the extent of the greater of $5,000 or 5% of the property that could have been withdrawn. That's its own rabbit hole subject. We're not going to dive down here because, like I said, in all this series, I assume you know about the gift tax and some of these issues. So really what we're going to look at is what happens after lapse here, and that lapse issue will slightly come in as we're going to see asterisk here, but this usually means that what you have to do is after the Crummey power lapses, it must be carved off into a separate subtrust for which one, the skip person who held the Crummey right is the sole beneficiary, and two, over which the skip person holds a power of appointment. Now I've asterisked this because, as I'm going to talk about on the next slide, it may not have to be a general power of appointment, and I'll explain why, because the only requirement is that it has to be included in the skip person's gross estate, not that they have to have a general power of appointment. Now, if the Crummey right does not meet these requirements, it will not qualify for the GST tax annual exclusion. So what's the result? What's the outcome? The outcome is that GST exemption, your $12,060,000 lifetime or death time exemption, has to then be allocated to the property which was subject to that Crummey right. You either have to allocate automatically or manually, even though there is no gift tax applicable credit here. So what this does is it creates a mismatch between the remaining gift tax exclusion and the remaining GST exemption. You're going to use up and deplete your GST exemption much more rapidly than you would your gift tax applicable credit through the gift tax exclusion, and end up with less GST exemption than gift tax exemption at death. And essentially what it means is you can't leverage this gift tax annual exclusion to make tax-free transfers if there's Crummey rights that don't meet these requirements. So one big benefit here, and this is where we tie in this power of appointment discussion, is that there's usual concern about lapses of Crummey powers that are treated as deemed gifts by the power holder, in this case to the skip person, to the other trust beneficiaries, might go away. And that's where we get into that whole lapse rule, the greater of 5,000 or 5%, which we're not going to dive into fully today. But one benefit here is that a GST compliant Crummey power avoids this, mainly because the skip person's power of appointment keeps this from being a completed gift to the remainder beneficiaries. Why? Well, in essence, this is where we get into the fact that you don't necessarily have to have a general power of appointment. Now, opinions are divided on this, but the conservative route is to give in this separate subtrust for a skip person to give them a general power of appointment. But you may also be able to consider the fact that diving down this gift tax rabbit hole, there's some guidance under the Treasury regulations for Code Section 2511 that say there's no gift tax until a gift is completed. And in this case, the gift is now no longer from the donor to the donee skip person. Instead, it's now from the skip person who had the Crummey power to the other trust beneficiaries. And you avoid this completed gift issue by giving the skip person any power of appointment, because if you hold a testamentary power of appointment, even if it's just a limited power of appointment, It causes gross estate inclusion by keeping this from being a completed gift to the remainder beneficiaries. And of course, you can keep lapsing this unexercised Crummey power held in this subtrust by up to $5,000 or, if greater, 5% of the skip person's trust share per year, because a lapsed amount at or below that threshold won't be treated as a gift under Code Section 2514E. So this is a way to avoid a general power of appointment, but still achieve the purposes of having the separate subtrust, the unlapsed Crummey powers, included in the skip person's gross estate, so as to get the GST Tax Annual Exclusion. So, how do we classify Crummey powers when we look at this? Most gifts to a trust will be indirect skips, as we've been discussing. However, Crummey powers, because they create this present interest, when they're held by skip persons, will be treated as direct skips. Now, that classification is important because, one, direct skips are going to get priority in terms of automatic allocation of GST exemption. And two, if you file a gift tax return, they're reported on different parts of Schedules A and D of that gift tax return, Form 709, which we're going to start to cover in the next few installments using a case study, which will involve Crummey powers. Drum roll. So, what are our key takeaways today? There's a lot that you just drank from the fire hose here, and I want to kind of put a bow on this by creating this hierarchy of what you need to check when you have Crummey powers in mind. You have several code sections you have to comply with. One is Code Section 2503B, which gives the gift tax annual exclusion but imposes this present interest requirement. You have to check that box. Two, you have to look at Code Section 2514E, which looks at the lapse limitations and could treat the lapse of the Crummey power as a gift from the Crummey power holder to the other trust beneficiaries, which we get around if we meet these requirements under the next code section, 2642C, which imposes the requirements for the donor to get the GST tax annual exclusion for direct skips. Now, most Crummey rights you encounter in trusts are only going to qualify for the first two and not number three, and in that case, if you fail number three, the test of 2642C, you're going to have to allocate your GST exemption to each Crummey right granted to a skip person. Now, there's some similarities here between the present interest requirement and the direct skip requirement. So for the gift tax annual exclusion, you have to have a present interest, and for the GST tax annual exclusion, you in essence need a direct skip that is a present interest for the GST tax annual exclusion. And the big key takeaway here is that even though the Crummey case controls on the gift tax side, it is indeed superseded in part by the statutory requirements relating to the structure of a Crummey power under Code Section 2642C. So, complicated subject, I know, so I'd encourage you to go back and review it and, listen to this again, because as we move on in this series and what's coming, this is going to start to move on from basics of GST tax into some more intermediate types of subjects. To really put a bow on the basics part, what I'm going to bring on next is going to be a case study of GST exemption allocations for some basic trusts on Form 709. We had to cover Crummey rights before I could really do that justice, hence why I've been promising that 709 discussion for several parts now and keep deferring it. I had to get through this part, now we can finally move on to that. And I'm also going to dive into GST exemption allocation on Form 706 at death, which has its own special nuances. But then from there, we'll get into the more intermediate types of things: reverse Q-tip elections and mechanics, evaluations, grandfather trusts and gallo trusts, and how constructive additions affect those, special eyelet considerations, and one that I've left off but deferred from a brief mention earlier, which is charitable lead trusts. So here's a glossary of the terms we've covered so far. Lots of terms. We didn't add anything new today. We're pretty much through the term part because we're assuming you know what a Crummey power is. So if you need a review, go back and refresh your understanding of each of these definitions that we've covered so far, and really add to your understanding, maybe reference it in the tax code and treasury regulations, now that you have some color to read the code and regs with respect to each of these terms and the context in which they apply. But I thank you again for listening to this part 11 of the basics of GST tax. If you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this video, and I look forward to seeing you in my future content.